I've put together 3 different investing portfolios depending on what type of person you are. One of these could be all you need to be a long-term successful investor. Let me show you how I've put them together. Here's the criteria I followed for all of the portfolios. It needs to be simple with not too many holdings, and this is going to make it easier to manage and maintain. Costs need to be an important consideration. This doesn't always mean we pick the absolute lowest cost because each investment will have different merits, but taking into account things like the ongoing charge and the spread of a fund, the portfolio needs to have good diversification so we're not putting too much concentration in a specific sector, region or country. Each of the portfolios uses passive ETFs, so we're not paying that extra fee to a fund manager to try and beat the index. We simply just want to capture the performance of a basket of assets. It would have been very easy to use one of these portfolios to simply hold one global ETF, but I thought that was too obvious. And while that should be the starting point for most investors, the first portfolio is a slight variation of a global ETF. The portfolio invests into 2 ETFs, one covering developed markets and the other covering emerging markets. There's 2 main benefits of splitting this into 2 ETFs. The first is cost, and this is slightly dependent on which provider you use. If you were looking at the Vanguard FTSE All World Index, this has an ongoing charge of 0.19%. We can roughly replicate this index by allocating 90% towards a developed markets ETF, such as the Vanguard FTSE Developed World ETF, which has an ongoing charge of 0.12%, and then the remaining 10% going to emerging markets, such as the Vanguard FTSE Emerging Markets ETF with an ongoing charge of 0.17%. This combined means our overall portfolio ongoing charge would be around 0.125%, much less than the 0.19% just investing into the FTSE All World ETF. I said this benefit is dependent on the provider, and that's because State Street have a fund with the ticker ACWI, which is very popular, called the MSCI All Country World Fund, and that has an ongoing charge of 0.12%. But the second main benefit is that it allows you to tinker. That 90-10 split is what a global ETF currently allocates. But this portfolio allows you to change those weightings depending on how you feel about emerging markets, for example. You might want to overweight that 10% to 15, 20, or even higher. That includes countries like China, Taiwan, and India. You may feel they have better prospects than some of the developed markets moving forward. It does mean that you may need to re-weight from time to time because whatever weightings that you select, they will drift over time as different regions will outperform each other. And you can do this in a couple of different ways. You could do it on a time basis. It could be every quarter, every year. Or you could do it on a percentage basis. So if you start with that 90-10 and it drifts to 85-15, you could set a threshold that when it moves more than 5% away from your weighting, you then decide to reweight. You also don't need to use Vanguard funds. You could, for example, use a combination of State Street funds. This is the SPDR MSCI World Fund, which covers developed markets, and then you could combine that with the SPDR MSCI Emerging Markets Fund. One thing to note when you are combining these is to stick to the same index provider, usually either MSCI or FTSE, and that's because of the differences in how they each categorize different countries, South Korea being the main one. MSCI classifies South Korea as an emerging market, where FTSE classify them as a developed market. And therefore, if you mix them, you could have an overweight or you could not include them at all. The second portfolio is for the more cautious investor. We're still going to allocate 100% to equity. We're now going to combine dividend-paying stocks with your classical growth stocks. Companies that have got a good track record of paying consistent and growing dividends over time tend to be more stable than your typical growth stocks. They may not have the same total return prospects. They tend to be more mature companies that pay more of their profits out to shareholders, and you tend to get more consistent returns. For this portfolio, the core is going to be in a global ETF. For this example, I'm using VWRP from Vanguard, and then we're going to have a tilt towards a dividend-focused ETF. For the dividend tilt, I've picked out 4 different options. The first is the Vanguard FTSE All World High Dividend Yield Fund. This is a global fund that focuses on high dividend payers. This is the most diversified by company because it has over 2,000 holdings. And then we've got the VanEck Morningstar Developed Markets Fund. And as the name suggests, it focuses on developed markets, but more specifically on companies that have displayed consistency and sustainability with their dividend payments. We can then take that one step further with the SPDR S&P Global Dividend Aristocrats Fund. This is a global fund, but it only invests into companies that have at least a 10-year track record of paying growing or stable dividend. And then in a slightly different direction, we have the iShares UK Dividend Fund, which simply focuses on the highest yielding UK stocks. One of the biggest things when combining ETFs like this is to consider overlap and concentration. All of these dividend paying ETFs will cause some form of overlap. You just need to decide which one you're comfortable with. For example, the first one, the Vanguard FTSE All World High Dividend Yield Fund, is the largest by number of companies, well over 2,000. So you could say it's the most diversified. But when we look at weighting by country, the US is the highest at near 38%. We have to take into account that we're combining this with a global ETF, which also has its highest weighting towards the US, currently sitting around 58%. The VanEck Morningstar Developed Markets Fund, on the other hand, when we look at weighting by country, is much more spread out. But there's much fewer companies in this index, covering just 100, and the top 10 has a weighting of just under 35%. It's also very heavily weighted towards financials, just over 40%. The Global Dividend Aristocrats Fund has a much lower top 10 weighting at just under 20%, but it has got a weighting of just under 48% towards the US. And then clearly the UK Dividend Fund is nearly all UK. Although having said that, when we look at overlap in a global ETF, the UK only makes up about 3% of the index. So really it depends on your priorities. Say for example, you wanted to overweight the UK because you wanted more than 3% in a global ETF. Well, then the UK Dividend Fund could act as a dual purpose. You get the security of dividend paying companies and also get some slight overweight towards the UK. If your main reason for picking dividend paying stocks was for stability in your portfolio, then something like the Dividend Aristocrats Fund would probably be your best bet, because although it hasn't got the most growth potential, it's going to be more stable because they've got the track record of paying those sustainable and growing dividends. The third portfolio is for the capital preservation investor, and this is where we're going to have a 60-40 split, 60% to equity and 40% to bonds. Generally, this will be more aimed at someone in retirement or getting close to retirement, when you're more concerned about capital preservation than you necessarily are about total return. And of course, that split can change depending on your individual circumstances. That 60% equity could simply just be one global ETF, or it could be a combination of some of the things we've already talked about. It could be that you want some income being paid out, so you pick dividend paying stocks not only for the stability, but also that income. And then we have the 40% allocation to bonds because we want to preserve capital and we haven't necessarily got the time horizon or the capacity to ride out any equity volatility. When it comes to picking bond ETFs, there will be some nuances, but generally for most people, picking a short-term government bond fund in your home country will be the most straightforward and simplest approach. When it comes to government bonds, especially in developed markets, you haven't got to worry about the government defaulting. So there's reduced credit risk there. So you haven't got to spread your money because you're worried that the government's not going to pay you. You'll have much bigger issues to worry about if that ever happens. You might look to diversify across a number of different countries because you're not quite sure of the direction of a specific central bank. For most Western countries, they will tend to move in the same direction, but they'll do that at different rates and different frequencies. My go-to UK government bond is the iShares UK Gilt 0 to 5 years fund. I like this fund because it focuses on relatively short-term bonds. Anything above 5 years, you will start to add some duration risk. That's where the price is more sensitive to interest rate changes. UK interest rates are coming down. We had 4 rate cuts in 2025, and it's predicted we might have 2 or 3 more in 2026. But the UK still has high interest rates than most of the G7. So from a return perspective, they're still one of the better performers. One of the other benefits for this fund is that it comes in both an accumulating and a distributing share class. For these types of funds, there's not usually many accumulating versions. That means if you're simply picking a bond fund because you want capital preservation and stability, you can pick an accumulating share class, so you don't have to worry about reinvesting any income. And similar to the first portfolio, when we're allocating a specific weighting, you will have to rebalance this from time to time. If the equity markets are rallying, it's likely that might shift from a 60-40 to say 70-30. And then that means you might have to sell that equity and buy more bonds. And that's not necessarily a bad thing, because if you do have to cap your equity, you're capping it when it's gone on a rally, so it's likely near the top. And it can work the other way as well. Say that 60-40 goes to 50-50 because equity has underperformed bonds. That means you have to sell your bonds to buy more equity. And because equity has underperformed bonds, you could be buying at a low. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. I wanted to show with these 3 portfolios that it doesn't need to be complicated. There's of course going to be nuances and everyone's got their individual circumstances. But even if you add some slight tilts to these 3 portfolios, you can use this as a core, as a guideline of where to start. I see so many articles and advisors out there saying you need to have 10, 20 plus different holdings when you cover the same thing by picking a few ETFs. And that's one of the biggest frustrations in the industry right now, is that complexity sells. We put it on this pedestal that the more complex a portfolio, the better it must be, the more that person must know about investing because they've got 40 different holdings. When really the boring approach is just to hold a few ETFs. But because it's boring, it doesn't sell. Let me know your thoughts down below in the comments. I hope you found that useful, and I'll catch you in the next one.